Did you know there is a company out there right now that just posted record-breaking revenue, aggressively expanded its profit margins, and added over 1 million brand new customers in a single 3-month stretch? And yet, somehow, Wall Street has absolutely hammered this stock, dragging it down more than 30% this year. Think about that for a second. Record growth, more customers than ever, and the reward? A stock that's been left for dead. It makes zero sense on the surface, does it? Well, today we're going to unpack exactly why the smartest analysts on Wall Street might be getting this one completely, catastrophically wrong. We're pulling back the curtain on what I call the SoFi paradox, separating the real, undeniable growth fundamentals from the relentless wave of market skepticism that's been crushing this name. And I promise you, by the end of this video, you'll see this stock in a way that 99% of retail investors never will. Because while everyone online is screaming about a massive short squeeze that's supposedly coming any day now, there is one single hidden metric buried deep in the balance sheet that changes absolutely everything about how you should value this company. Stick around because you will not want to miss it. Before we dive in, if you find value in this kind of deep, no-nonsense stock breakdown, do me a quick favor and smash that like button and subscribe. It genuinely helps the channel grow and takes you just 1 second. All right, let's get into it. But here's the thing. To truly understand why this stock is bleeding out on the chart, we first have to look at the two extreme camps that are absolutely tearing this narrative apart. And trust me, the gap between them is wider than you'd ever imagine. Look at this bizarre, almost unbelievable disconnect. On the left side, we have pure, unfiltered business acceleration. We are talking about 43% year-over-year revenue growth in the first quarter of 2026. Let that number sink in, 43%. And it doesn't stop there. Their profit margins didn't just inch upward the way most companies celebrate. No, they expanded by nearly 600 basis points, leaping from 9.3% all the way up to 15%. That is a phenomenal textbook example of a company scaling efficiently. But then, on the right side, you have this brutal, almost violent market contraction. The stock is stuck trading down near its lows, hovering somewhere in the $17 to $18 range. So how on earth can a business be firing on all cylinders while its stock price is stuck in the gutter? It's a complete and total paradox. It shouldn't be possible. And if we dig a little deeper into the actual numbers behind this story, we quickly discover that the market itself is entirely fractured, split right down the middle into two completely different realities that cannot both be true. Right now, if you go online and spend even 5 minutes reading the comments, you will find two violently opposed tribes screaming at each other. On one side, you have the retail bulls. These are the folks who treat SoFi like some kind of unstoppable, hyper-growth tech darling that is completely immune to the laws of gravity. They're chasing forum fantasies, convinced the stock is about to triple overnight. And then, on the complete opposite side, you have the institutional bears. These are the serious money managers pushing a much darker narrative, claiming that SoFi is a fundamentally broken growth story. Many of them are leaning heavily on a now infamous Muddy Waters short report, which went as far as to allege, and I'm quoting the spirit here, Enron-esque accounting practices. So who's right, the euphoric bulls or the doom and gloom bears? Well, here's what almost nobody wants to admit. The actual truth lies far, far away from both of these emotional extremes. Now, none of this really matters unless we take the time to look at the specific risks the bears are so desperately clinging to. So let's give them a fair hearing. Let's cut straight through the noise and carefully deconstruct this entire bear case piece by piece. The market, as it turns out, is heavily discounting SoFi based on three main fears. First, there are those fair value loan accounting allegations coming directly from the short sellers, the very heart of the Muddy Waters argument. Second, there's a genuinely concerning 27% revenue drop in their technology platform segment, largely caused by the loss of one major client. And third, there's creeping credit risk, with their unsecured personal loan charge-offs ticking up to 3.03%. Add all of this together, and you can see why the market has become laser-focused on software contraction and macro credit fears. On paper, it sounds genuinely scary. It sounds like a company in trouble. But that's only half the story. And I mean that literally, because the moment you pull up the fundamental snapshot and look at what's actually happening inside this business, a wildly different picture begins to emerge. This right here is exactly what happens when you strip away all the emotion, all the fear-mongering, and all the hype, and you simply look at the cold, hard data. In the first quarter of 2026, SoFi generated a staggering $1.09 billion in total revenue. Their net income came in at a healthy $166,700,000. And here's the part that should stop you in your tracks. They added 1.1 million brand new members in just 3 months. 3 months. That brought their total member base up to a massive 14.7 million users. So let me ask you this. Does that sound like a company whose growth engine is stalling out? Because that's the entire bear thesis. And the data completely and utterly contradicts it. The business isn't stalling. It's firing on almost every single cylinder it has. Yet despite all of this massive, verifiable growth, there is a deep structural advantage hiding in plain sight, an advantage the market seems to be completely and inexplicably ignoring. This, my friends, is the true engine driving SoFi right now. And it's something the panic sellers keep forgetting about, the bank charter. Now, why does this matter so much? Well, unlike traditional fintech companies, think of names like Affirm, who are forced to rely on external capital markets and expensive warehouse borrowing just to fund their loans, SoFi is playing an entirely different game. They've quietly, methodically swelled their deposit base to a jaw-dropping $40 billion, $200 million. And here's the magic of it. Having access to those cheap, sticky customer deposits saves them an estimated $621,800,000 in annual interest expenses. Just imagine that. Over $600 million in savings every single year simply because of their structure. That is a massive, deeply defensive moat that insulates them from the kind of capital market volatility that could sink their competitors. So why isn't Wall Street pricing this in? That's the billion-dollar question. So with all of these deposits and all of this structural strength, what exactly is this company actually worth? And this, it turns out, brings us straight into a massive identity crisis. This right here is the exact dilemma that's keeping institutional investors awake at night, tossing and turning. It boils down to one deceptively simple question. Is SoFi a tech company or is it a bank? Right now, the stock trades at premium tech multiples. We're talking about a price-to-earnings ratio hovering somewhere around 36 to 40 times earnings and a price-to-sales multiple of 5.2. Those are rich growth stock numbers. But here's the enormous elephant sitting in the middle of the room. Their lending segment currently generates 8.6 times the revenue of their actual tech platform. Read that again, 8.6 times. So which one is the real business? And here's the terrifying scenario for the bulls. If Wall Street ever permanently decides to re-rate SoFi as just another digital regional bank rather than a shiny tech disruptor, well, standard bank multiples sit much, much lower, closer to 10 times. If that re-rating ever happens, there is some serious multiple compression risk lurking beneath the surface. Could that be what the market is quietly bracing for? And speaking of risk, we absolutely need to address the single biggest elephant in every retail chat room across the internet, because this one, I'm afraid, might just break some hearts. If you've spent literally any time at all on platforms like StockTwits or Reddit, then you've heard the endless chatter about the incoming, quote, mother of all short squeezes. It's practically a religion over there. So let's actually do the math together and see if the dream holds up. Yes, it's true. Short interest is genuinely high, sitting at roughly 15% of the float, which translates to about 188 million shares sold short. That sounds like squeeze fuel, right? But here's the catch that nobody in those forums wants to talk about. You simply cannot have a historic, legendary short squeeze without a trap. And there is no trap here. Because SoFi's average daily trading volume is over 80 million shares, the critical days to cover ratio comes out to a measly 2.0. What does that mean in plain English? It means the short sellers could comfortably exit every single one of their positions in just 48 hours without even breaking a sweat. There's no bottleneck, no trap. The massive, life-changing short squeeze everyone's dreaming about, it's a retail fantasy, plain and simple. So if the retail squeeze isn't actually happening, then that forces us to confront a far more uncomfortable and important question about the broader economy as a whole. Here's the real puzzle. Why on earth did the market violently sell off a stock that had just beaten revenue expectations by 43%? I mean, that's the kind of quarter companies dream about. Well, here's my theory, and I think it's the one that actually holds water. I believe the market is quietly front-running a much broader consumer credit crisis. Think about it. With those personal loan charge-offs already sitting at 3.03%, and with stubborn inflation potentially forcing the Federal Reserve into a higher-for-longer interest rate environment, SoFi's unsecured personal loan book could suddenly face some very significant pressure. And this is the key insight. The market isn't really punishing SoFi for yesterday's numbers, which were fantastic. Instead, it's looking 6 months, maybe even a full year ahead, peering nervously into a potential consumer default cycle. In other words, the stock isn't being judged on its present. It's being judged on a future that hasn't even happened yet. But here's where it gets really interesting. While the retail investors are busy panicking and hitting the sell button, you will be genuinely shocked to see what the so-called smart money is quietly doing behind closed doors. On the surface, if you just glance at the headlines, Wall Street analysts appear to be playing it incredibly safe. The consensus is cautious, sitting at 11 holds, 7 buys, and 3 sells. Pretty lukewarm, right? But don't let that fool you. Look at what the whales are actually doing with their capital. Because beneath the surface, there is quiet, deliberate, strategic accumulation happening. For instance, UBS recently scooped up over 21 million shares. 21 million! And the Illinois Municipal Retirement Fund? They went ahead and increase their entire stake by a full 25%. So think about the disconnect here. While the public-facing analysts are telling you to sit on your hands and wait, some of the biggest institutional heavyweights in the game are quietly, methodically loading the boat. Now, why would they be doing that if the story were truly broken? And it's not just the outside institutions buying up this dip. In fact, the single most important signal of all is coming from inside the house itself. Here's a rule I want you to remember for the rest of your investing life. Watch very carefully what executives do with their own money, not what short sellers say in their reports. And on this front, the signal could not be louder. SoFi CEO Anthony Noto recently stepped in and personally bought over 15,500 shares with his own hard-earned money, right around the $16 level. Just think about the psychology of that for a moment. Short reports are just theories, hypotheses, guesses dressed up in fancy language. But executive cash on the line? That is cold, hard reality. When the chief executive of a company drops $250,000 of his own personal capital into the stock while it's bleeding out and under attack from accounting allegations, well, that is arguably the single loudest, most convincing bullish signal on the entire board. Actions speak louder than short reports. So how in the world do we reconcile this powerful insider confidence with the brutal, discouraging reality of the actual stock chart? Because those two things seem to be living in completely different universes. The disconnect here is frankly absolutely jarring to look at. On one hand, the company is guiding for approximately $4,660 million in annual revenue this year. That represents a robust 30% year-over-year growth rate. That's a company clearly on the move. Yet on the other hand, the actual price action is stuck in this grueling, choppy, soul-crushing channel, bouncing aimlessly between $17 and $19. So on your screen, you have two arrows pointing in completely opposite directions. The fundamentals are pointing sharply up and to the right, like a rocket preparing for launch. But the stock price? It's just flatlining, stuck in the mud, going absolutely nowhere. How long can that kind of tension possibly last before something finally has to give? And for that tension to finally break, we need to turn our attention to the emerging catalysts, the specific events that could finally blast this stock out of its long, frustrating rut. To truly shift the entire market narrative away from this idea of broken growth and back toward the reality of efficient scaling, SoFi realistically needs two key things to happen. Pillar number one is tech platform normalization. In plain terms, they simply have to move past the loss of that one big client and stabilize their baseline software revenue, proving that the segment isn't in permanent decline. And pillar number two is small business expansion. By successfully scaling up their brand new small business loan segment, they can begin to diversify their revenue streams away from a heavy reliance on just consumer credit. If they can execute on both of these pillars, the entire investment thesis flips. So the real question becomes, can management actually deliver? Which brings us, at long last, to the ultimate payoff of this entire analysis. What exactly is the actual, realistic, grounded outlook for this stock moving forward? All right, let's bring absolutely everything together into one clear picture. First, the Muddy Waters view, the one claiming this is a fraudulent house of cards destined to collapse all the way to zero. Based on the data we've walked through, that is simply false. But hold on, don't celebrate yet. The wildly optimistic retail view, the one insisting this is a future trillion-dollar tech monopoly about to squeeze straight to the moon. That one is also false. The genuine, realistic view, the one grounded in evidence, is that SoFi is a highly efficient, rapidly growing digital bank that is successfully transitioning into consistent, durable profitability. It's not a scam, and it's not a lottery ticket. It's a real, functioning business. And based on this exact trajectory, a target price somewhere in the range of $21 to $22 isn't just some hopeful, pie-in-the-sky guess. It's actually a highly probable outcome grounded in the fundamentals. Not sexy, but real. So let's take all of that and wrap it up neatly into one final actionable summary you can actually walk away with. Here is your bottom line, the executive summary of everything we've covered. The fundamentals of this company are undeniably strong. We're talking about 43% revenue growth paired with a formidable $40 billion deposit moat. Those are the pillars of strength. However, and this is important, the market headwinds are also very real. Specifically, there's that ongoing valuation tension, the constant tug of war between being priced as a high-flying tech company versus a stable, boring bank. So here's my parting advice. Don't fall for the seductive retail squeeze fantasy because the math just isn't there. But absolutely do pay very close attention to the quiet institutional accumulation and that powerful insider buying. When you put it all together, the downside appears severely limited by the protective bank charter, while the upside relies almost entirely on the company's ability to execute flawlessly and survive the looming macro credit fears. All things considered, a $21 to $22 target is a completely reasonable expectation for the patient, pragmatic investor. Now, before we close out, a very important and necessary disclaimer. Everything you've heard in this video today is provided for informational and educational purposes only. It is absolutely not financial advice. I am not your financial advisor, and nothing here should be taken as a recommendation to buy, sell, or hold any security whatsoever. The stock market carries real risk, and you can lose money. So please, always do your own thorough research and consider consulting with a licensed financial professional before making any investment decisions with your hard-earned money. With that out of the way, I want to hear from you. Here's my question for the comment section, and I'm genuinely curious. If you had to place your bet today, do you think Wall Street will ultimately re-rate SoFi as an exciting tech disruptor or as a boring traditional digital bank? Because that single distinction could mean the difference between a stock that doubles and one that goes nowhere. Drop your answer down below and let's get a real debate going. If this deep dive brought you genuine value and helped you see past the noise, please do me a huge favor by tapping that like button and make sure you're subscribed with notifications turned on so you never miss the next breakdown. Thank you so much for watching, and I will see you in the very next one.